Is my internet, is this okay? Can you guys hear me okay?
Yeah, you're good.
So there's a lot of misconception about how mortgage rates are determined, and I really wanted to talk a little bit about that, especially how it affects us in the real estate business, right? So traditionally, before we had the last recession, mortgage interest rates were determined by the market. The market meaning based upon how investors invested in mortgage-backed securities or their equivalents. Based upon that, mortgage rates went up or down. So if the prices of mortgage-backed securities went up, then the interest rates went down. There's an inverse relationship. So, and when does that happen? When do prices go up? Well, prices go up when investors, when I mean investors, I mean institutional investors, pension funds, mutual funds, countries like the country of Japan or China, when they're investing. So generally, they're in denominations of $100 million. So when these investors say, I want to invest in something very safe, then they invest in what's the safest security in the world is the U.S. the U.S. debt. U.S. debt is anything over 10-year um, duration, the 15-year bond, the 30-year bond. Those are called bonds. 10 years the note, 5 years the note. Anything under that is like a bill, like the 6-month T bill, the Treasury bill, the 1-year Treasury bill. So what happens is that when the stock market is doing well, people want to invest in the stock market, and so they don't invest in mortgage-backed securities or U.S. government securities. So those prices go down and the interest rates go up. So if we look right now, it's a booming economy. Institutional investors are investing in the stock market, and they're not investing in government securities and in mortgage-backed securities. So mortgage rates have gone up. Now, that's how it's always been, you know, up until the last recession. And to some extent, it does happen now. But in the last recession, the US government, for the first time, started buying its own securities. So what they did is they said, okay, we need we need $100 billion. So they would go to the presses and print $100 billion, and they would loan it to themselves, and then they would pay interest to themselves. And they did the same thing with mortgage securities. So the mortgage rates are no longer more driven by the market; they are government controlled. So now there are still institutional investors that buy mortgage-backed securities, and that does drive market rates, but it's now mostly controlled by the U.S. government. Um, so if we look at what happened what's been happening recently since COVID, we saw interest rates. When the recession hit, that's when we saw interest rates going down into the in you know to around eight, from the eights to the sevens to the sixes to the fives to the fours, and now to the three, then down to the threes. Um, that's because the economy was bad, and in a bad economy, there's an inverse relationship. When the economy is good, sorry, there's a the relationship is directly proportional. So So when the economy is good, interest rates will go up. And when the economy is bad, the interest rates will go down, right? So right now, and that's really because the government wants to control inflation. And when we hear this term, oh, the Fed is going to lower rates, the Fed is going to lower rates, that does not impact that does not impact real estate agents and real estate buyers. It does not impact them directly or indirectly. It does not. That's a complete fallacy. So what happens is when the Fed lowers their rate, what that means is the rate that they charge to give money to banks to loan to their customers, they're adjusting that. So what happens is that, like, I have a on the building that we have our office in, that I have a an interest rate that's driven by prime. So when the government lowers their rate, like they just lowered their rate 1/4%, my rate is indexed to prime, so my rate goes down 1/4%, right? People also that have home equity lines of credit, so those people that had 2%, 3%, 4% interest rates, they need cash. They got to pay off credit cards. They got to send their kid to college. They got to go on vacation, whatever. So they're going into debt by credit cards, so on and so forth. And so they're getting home equity lines of credit. They're not refinancing, right? They're not, because they don't want to touch that 3% mortgage, that interest rate. So now they have that a second mortgage. Now, second mortgages, home equity lines of credit, are indexed to the prime rate. So those people that are already homeowners, they are affected by when they say, oh, interest rates are going down, interest rates are going down, right? But it has no impact. That has zero impact on us. That's why when the interest rates came down recently, 1/4%, came down last week, the Fed lowered the rate. The 10-year no the interest rates actually went up, right? So when you hear that, don't think that it's driven. Our mortgage rates are determined by the 10, are indexed. Okay, they're indexed to the 10-year Treasury security, which is called the note, the 10-year note. So the 10-year note, based upon that going up or down, is how mortgage rates go up or down. And the 10-year note will go up or down based upon economy. Now, where are we at right now? Okay. This is the question. Where are we at now? And where are we gonna be? So I was of the impression that when the economy has been very, very strong the last couple of years. It doesn't matter what the Democrats say and what the Republicans say. It's been a very strong economy, right? Stock market, which I don't really look at the stock market as an indicator, but for the economy, but it's an indicator for consumers. They think that the stock market has something to do with our economy, and that drives consumer sentiment. And what consumer sentiment drives is consumer spending, which is really, really important for our economy. So what happens is that consumers are spending money. We have a very, very high employment rate, right? And again, they're spending money. They're putting money into the economy. So the economy is it's the 800-pound gorilla. Everybody's buying, driving up prices, right? Supply and demand. A producer of something says, "Hey, listen, I only have 10 widgets. I only have 10 widgets left. I usually sell them for $5. I'm going to sell them for $5.10. The guy that uses widgets in his component to build something, he's going to raise his prices based upon the prices of the widgets. So oil is an important indicator, right, for interest rates. So I think, I was hoping that before they started lowering rates, the Fed, on the prime rate, because the prime rate has an effect on the economy, right? And not on mortgage rates, but it has an effect on the economy. So so if the prime rate went up, borrowing costs went up, employers would be forced to start doing layoffs, and and once that happens, consumer spending lowers, uh, gets lowered, which is actually that's really the most important thing, right? Is what consumers are spending. So consumer spending goes down, unemployment goes up. I was hoping that they would continue to increase rates, so that if they continue to increase rates, we would have a sharp drop in interest rates. So now what they've done is they want to have what's like a soft landing. A soft landing means that they don't want to have 8-9% interest, unemployment rates. They don't want to. They just want to have unemployment go up a little bit, have the inflation come down, and it just be the interest rates be somewhere around 5.5%. That's kind of what I'm feeling, that the government is hoping for. So by them lowering the rate in a good economy where unemployment is low, uh, I don't know why they're doing it. There's no basis for it. They really should not be doing it. I mean, I look at the same numbers they look at. I don't know. Maybe they have some secrets that I can't see, but it doesn't make any sense to me. The one thing that there is an outside chance of is deflation. Okay. So deflation means when there's inflation, that means that the economy is growing faster than it should, right? And deflation, which we were in for a long, long time, we couldn't get out of it. Montgomery prices and even our real estate prices, Montgomery, the whole corridor, Montgomery, Hillsborough, this whole area, prices were not going up more than 2-3% for years. That was going on. So what we if we get back to deflation, then we might see interest rates come down sharply. So I think the new norm, like right now, we are at 7% interest rates. When I came back from Florida yesterday, there was a person that was sitting next to me that was that worked for Toll Brothers, and he was bragging about, oh yeah, 50% of our buy, we're luxury, we're this that, 50% of our buyers buy with 50% or more down payment, and all that stuff. And you know the I think that we all have to understand um, that until you know their rates are at 7.5%. By the way, he was saying 7.5%. Toll Brothers has a mortgage company. Their rates are at 7.5%, and he said that their sales have been steady. They don't see any decline. They don't see any issues with the market, which I was really surprised at. But I guess it is what it is. I mean, the horse was sitting right there. I was getting it right from the horse's mouth. So, um, but 7.5% interest rates, or let's just call it seven, okay? 7% interest rates, I believe, has a very serious impact on first-time home buyers, right? I think that those are the people that get hit the hardest on all of this. When interest rates go up, and when you get a comment from a luxury homemaker like that they really don't care if interest rates go to 10%, really the impact is going to be on the first time home buyer, right? There's a lot of market dynamics that's going on. I think we've kind of settled into a new norm. Where we are now, we kind of hit 5.75 for a couple of for a few weeks. We may have gone down as low as 5.5, I think. But I think we're at 7 right now, and I think we're gonna be in this 6.5%, 6, 7 in that range. Because keep in mind, um, around the second or third year of Trump's first term, we did hit 8. We did hit 8. People didn't realize it because people didn't realize we did. We were in the sevens. We were in the sevens. We were in the 8. We touched the 8s. Then we were into the 6s. And then we came down again. So, um, I don't think that. I think that people are going to continue buying homes. I think it's just um, the numbers are the numbers. I think talking to all the agents. I remember in this time last year, when we were in uh, Atlantic City at Triple Play. I met, there's a guy from Hillsborough. He's actually claims to be a national speaker. His name is Scott Einbinder. Scott was there, and he had a couple of his cronies, and he was just like, "Yeah, the real estate market, there's gonna be no more. There's not gonna be any more real estate agents anymore. There's just not gonna happen anymore." I said, Scott, and I know Scott since the 80s. I've known him for a long, long time. He used to be one of my technology customers. So I said, Scott, listen, we've been around a long time. All this stuff about there's always this song about how realtors are going to be gone, right? Just never happens. Whatever happened as a result of this buyer's agency issue, I think that most successful agents will tell you that it's the best thing that ever happened. And that's how it played out. I didn't call that. I didn't say that it's going to have a positive impact, but I did say that it was not going to have any impact on it because people need to have agents. I had a call for the real estate school, and the guy wanted to get his real estate license so he can save a commission on selling his house and make a commission on buying his house. I said, listen, I tried to sell my house last year. I've been in this industry for 40 years. And let me tell you something. A good real estate agent really earns their commission and they are worth it. And I think that good agents can appreciate that statement, what I just said, and they have no problem with charging their fee. The people that have a problem with it are the people that don't provide value in the transaction, you know, and they don't believe that they should be paid. And just like any other discount, you get what you pay for, right? So yeah, Maddie. So yeah, there's I mean, I can tell you so many stories. I can personal stories about my father and his home buying experience on how real estate agents had such a positive impact on lives of people. So now, as far as the mortgage products go, there's, at Visionary Mortgage, we've got a lot of great programs, 100% financing, USDA loans. Um, it's really become very easy for a home buyer, and it's still, in many cases, it's cheaper to buy a house than renting, right? If you look at the tax, better to purchase a home, right? So, and when lenders are now, there's new lenders coming on the market. There's a lot more competition, so they become much more creative in the products that they can offer, right? So So, if you've got, I mean, there's plenty of opportunity. I mean, I know I was uh, Nim and Karan. They just bought a flip. You know, and there's so much. If you're out there and you see an opportunity and you want to buy something, there's plenty of ways to get money. To buy properties. Where your income is not important. What is important is the property and the opportunity. What is the after repair value going to be? What is the cost going to be? These are things that you should really start thinking about, and educating your clients about. If you do see a flip, um, and there's always opportunities. There's always opportunities. So, to get your real estate out license, for those of you that are considering it, I highly recommend it. Oh, we have a great second mortgage program, by the way. If you've got a seller that needs money, it's 1 week, and it's pretty much no doc. They can get their money in a week as long as the house is not listed. They got to put in a new septic system, whatever. 80% loan to value. So let's say the house is worth, 100,000, just for illustration purposes. 100,000, they owe 40,000. The max they can get on the second is another 40,000. Quick, easy. It's if they don't have income, or the bank is going to give them a hard time, or they need the money quickly, we can do it. Um, and you should think about getting your mortgage license, because it's a great credential to have. And if you can make an extra 1% on a transaction, or another 2% on a transaction, then you should do it. But knowledge is important. So you should definitely and all these people that are out there getting 7, 8%, 10% mortgages, someday they're going to be refinancing, and why not you make money on it as opposed to somebody else? If you have any questions regarding that, please, let me know.
So
um,
1% of the mortgage or 1% of the house value?
1% of the mortgage.
Okay, thank you.
Yeah. But Dina, also, it's really, I mean, it's not, you can make 2%, you can make 2.5% on mortgages, but you're going to have situations where people will call you and they'll say, listen, I need money to send to India. I need $100,000. I need it as soon as possible. I get calls like that. We get calls like that all the time. Emergency. My daughter's buying a house. She needs money. I need to get a second mortgage. Can you help me out? Stuff like that. So, people are always looking for money. It's definitely, and it's only 24 hours. The course is only, it only takes, it's 24 classroom hours. We do it online on Zoom, and it's only 249. Once you do your first transaction, we refund it, and then we give you, we'll give you a list where you can call and you can say, hey, listen, I can help you with absentee owners. I can help you with your property. I can help you with property management. I can help you find a tenant, and I can help you sell it. It's a great time to be a seller. I can help you refinance it. I can help you take cash out to buy another investment property. We have no income verification programs. It just gives you another tool, to talk to people about, and to facilitate a transaction. So that's that. If any of you have any questions or any issues, you know where to find me. Thanks for your time, and have a great day. Any questions that I can help with? No? Okay, good. Thanks, and have a great day.
Thanks, Raj. Have a
Thank
great
you.
Thank
one.
you.
Take
Thank
care.
you.
Thanks, guys, for coming on.
Thank you.
Thank you.
You're welcome.